Hi, I'm Bob Powell with The Street. I recently attended the Investments and Wealth Institute Investment Advisor Forum in New York City, and many experts spoke about the need for investors to commit a portion of their portfolio to emerging markets. One such expert was David Semple, the portfolio manager of VanEck Emerging Markets Fund. Semple told me that investors searching for current income can certainly look for fixed income securities, but that they shouldn't overlook equities.
Sure. Well, I'm an equity guy, so I talk about equity more than anything else. But there are obvious scope for carry trades as a minimum in emerging markets, where you can get good yields on both the sovereign hard currency bonds, but also the local currency bonds as well, and corporate bonds allied to that. For equity, there's not been as much of a tradition in terms of dividend paying, and that really is because of the maturity, where they are in the maturity cycle for corporate life, if you like. And there's always been a lot of reinvestment of operating cash flows into new plant, new equipment, new business lines, whatever it happens to be. Now, that has actually changed a little bit over the last few years, in the sense that the investment into things like CapEx has actually come down. And I think companies are more focused on running good economic growth through their P&L, if you like, to actually generate returns for shareholders, rather than spending the money and investing ahead of what are high growth economies. So it's changing a little bit, and I think that you'll get incrementally higher and higher shareholder returns. Now, I say shareholder returns because it's not just the dividend, it'll be share buybacks as well. There's not as much of a tradition there, and certainly not the sort of scale that we've seen in the US over the last few years. So if you combine those two, the actual give back to shareholders is about half of what it is in the US as a percentage of operating profitability. So there's plenty of scope for that going up, allied to the fact that there's a lot more advocacy for that type of thing to happen. Corporate balance sheets are very strong, much stronger than the US in terms of listed companies, much less leverage, and so advocates have been talking to the companies and saying, look, you're generating a lot of cash flow, you have cash on the balance sheet, your payout ratio is 20%, let's say, what are you going to do about it? And increasing that's companies are more receptive to that. So although it may not be a great yield play right now, what you get, I think, with that is yield plus growth. So that incremental increase in yield, even if operating profitability stagnates, you're going to get more dividend out of that in the future. So it's sort of tapping into a rich seam, if you like. But it's not just that. Companies are growing and paying out higher dividends. So you should think of EM equities as a growth plus income and a diversifier to some extent, particularly in terms of currency as well. EM currencies are, broadly speaking, undervalued, I believe, versus the dollar. And I think they may be undervalued for a long time, but it's a good place to start, is to buy when they're undervalued rather than when they're objectively overvalued.
According to Semple, there's at least one stock that offers the kind of growth plus dividend plus diversifier of which he speaks.
Well, the sort of poster child for getting better for governance in a general sense would be something like Samsung Electronics, where there clearly is a lot of work to be done. And they generate an awful lot of cash flow, free cash flow yield of about 11-12%. They could pay out a lot more, and now they're starting to pay out more. And things like, they used to buy back shares but not cancel them, keep them as treasury shares, now they're cancelling them. And that reduces the share count and improves the earnings per share. So it's still, again, not a yield play. You do get a dividend. It's not high, but it could be so much higher. And so, if you have a reasonable time frame, and we're not talking a year or 2 year, we're talking a little bit longer than that, you should see incremental step up in terms of income for investors out of these. Now, a lot of these you can't buy directly as an individual investor, so there has to be through a fund or through a passive solution. But it's certainly an area where you can see the growth in dividends. So maybe not year one, but year 5, you're going to see a good growth in what you're going to achieve in terms of shareholder return.
Semple also spoke about the types of emerging markets companies that VanEck invests in.
Well, dividend is part of the expected return for any company, and dividends have been very important, particularly in Asia, as being the highest component of the historical return. And I don't think that'll change. So for us, we like to buy companies that are structurally growing. That's what we do. We don't buy any companies, or we really steer clear of companies that have highly cyclical earning streams, because we don't want to engage in the invidious task of trying to time cycles. What we really want to do is spend our time finding companies that have a visible and persistent growth, and at a stage in the maturity of the company that kicks off a lot of cash. So some of them might be in the early stage, some of them might be in the later stage. But if we get it right, they're all moving towards that, where they'll generate that kind of dividend.
To be sure, emerging markets are more risky than developed markets. But Semple suggested investors, including those saving for or living in retirement, might consider allocating a portion of their portfolios to emerging markets.
Well, I can analyze everyone's risk profile, and obviously people have to do what they feel comfortable with. And objectively, emerging markets has been a riskier asset class, albeit that the return over the medium to long term generated by emerging markets has been very strong as well. So it's definitely not an all your eggs in one basket type of approach to this, but it does form a nice balanced part of a broadly balanced approach to diversified retirement solution, I believe. Everyone will be different, but I certainly don't shy away from suggesting that it should have an allocation for people approaching retirement, people saving up at early stages, and even people in retirement as well.
Semple also made the case for investing using active management more so than passive management, at least when it comes to emerging markets.
The thing is that there's so much scope for adding value as an active manager. The emerging markets are changing rapidly, and if you invest in a passive solution, which basically is targeting an index, indices are historical constructs. In other words, they describe what has happened, the state of after what has happened, here we are now, and don't describe what is going to happen at all. And if you buy into the thesis that emerging markets are constantly changing, which I believe they are, then you should be looking forward to what is potentially going to happen. So an example of that would be in China. If you go back 2 or 3 years and look at what the index told you to invest in China, you'd have an awful lot of smokestack industries, excess capacity industries, financials, banks, those sort of things. And you may have completely missed some of the new economy, which is the area that's really growing in China. The healthcare, the education, the tourism, the internet, all these things were relatively poorly represented in the index, and they're becoming a much larger part now because they're doing so well. So that's why I would advocate for that. And then, when you get down to the stock level, actually picking the stocks is really important in emerging markets, because there's a wide range of capabilities and philosophies amongst management. And so we have arguably 2, 3, perhaps more thousand companies to invest in, of which we'll buy a very select few. So there's a large menu. It's not like a restaurant where there's a large menu and you're very skeptical about it because they can't do everything. There's a very wide variety of things we can invest in, and there's a lot that we just simply don't need to touch. So picking the right stocks means more to us, and I think objectively in terms of available alpha, than picking countries, picking sectors, picking currencies. Companies matter most.
Of note, there were 86 holdings in the VanEck Emerging Markets Fund as of December 31st, 2017, and the top 10 holdings represented 36.83% of the fund. But, Semple said, those holdings don't necessarily reflect what the fund is about.
It's usually about 25, 26, 27% of the portfolio is the top 10. You get a little bit of a mistaken impression of what we do, because in the top 10 we tend to be amongst the larger companies, However, we do a lot of investing in small and mid-cap companies in emerging markets. And the reasons are really quite simple and I believe quite compelling. First and foremost, you get more growth out of those. I mean, I don't need to belabor that point. Secondly, they're cheaper. It's not immediately apparent necessarily because in large cap, there's a lot of cyclicals, value for a reason. There's a cyclical earnings stream and a lot of state ownership. In small and mid cap, you get a much different type of company. Thirdly, they're very much more geared towards domestic demand. And that's kind of the future of emerging markets. It's not really nimble fingers making goods for you or I. It's not about digging things out of the ground. It's about producing services and consuming services and making goods and consuming goods in the country for the country, in places like China and India. And that's what small and mid cap gives you much more. And then finally, and this is counterintuitive for people when they first hear it, investing in small and mid cap in emerging markets brings down risk in your portfolio because there's a there's a much less correlation amongst those companies that are individual companies in individual industries, in individual sectors in individual countries. So if I buy a Thai convenience store operator, a South African taxi financer, a Brazilian medical diagnostic clinic operator, they have nothing to do with each other. And so, yes, there's stock-specific risk, but as you put them together in a portfolio, that lack of correlation means you draw down the risk of the portfolio.
In closing, Semple said now is a good time for investors to consider emerging markets.
Yeah, I would just say that for emerging markets, we're, I think, in a pretty good place right now. We're maturing in many senses and in good senses as an asset class. The macro environment is pretty benign. We have good global growth, good global liquidity. It's not an overvalued asset class, unlike many others. And it's not an over-owned asset class because positioning is relatively light in emerging markets. So I think we have 2017 was a great year for emerging markets. I think we look forward to 2018 with pretty good optimism. We wouldn't posit a year exactly like last year because it never is. But a good year, I think, is certainly something that we could anticipate.
And that was David Semple from VanEck Mutual Funds. I'm Bob Powell for The Street.